Today we're talking about captives. Many employers that are exploring self-funded health plans have probably heard the term, but don't fully understand what captives are all about. So we want to do a little bit of a deep dive to help employers make the right decision and find the right fit for them to help their self-funded plan perform better moving forward. In the context of a health plan, a captive comes into play when we're talking about stop-loss insurance or catastrophic insurance that protects you from those really large claims. The idea of a captive is like-minded employers coming together to form their own insurance company. By doing so, they control how the plan operates and how the insurance company operates, and then they can benefit from the profits that typical insurance companies would take for themselves. Captive insurance companies are not a new concept. About 15 years ago, they started really growing in popularity, and now it seems that everybody and their brother is creating one. So we think it's important for employers to understand why a captive would make sense for them and how they pick the right one for their particular needs. Historically, prior to captives coming into vogue, the only option employers had when shopping for stop-loss or catastrophic insurance was to buy it from a commercial insurance company. And the challenge is that many employers would go years paying premium to these carriers and not necessarily see any reimbursements for catastrophic claims. And so every year they'd feel like they're making a donation, and that gets frustrating after a while. So the concept of a captive is where employers can come together and they can use those surplus profits that would otherwise go to an insurance company. They can use them to manage their insurance company, their captive, however they see fit. And there's two primary ways that members of a captive really use those surplus dollars to benefit the members that have come together to form this insurance company. Option A is they can use those surplus dollars to reduce everybody's premiums so they all pay less than they would if they went to the open market. Option B is to use those surplus dollars and return them as a dividend to the shareholders at the end of the year if the plan ran well. In both cases, the employers are benefiting because if the plan performs well, they're not necessarily making a donation to anyone other than themselves and their partners in the captive. Some captives use a all-for-one, one-for-all model where it doesn't matter how any particular employer or member of the captive performs, it's solely how the plan as a whole performs at the end of the year that determines what the premiums will be for the next year or whether an employer gets a dividend. Others will actually hold your experience against you, and that's not necessarily a bad model, but you may not have the benefit then of the captive in a particular year when your plan performs poorly. So there's no right or wrong answer there. It just depends on risk tolerance and what it is that you're particularly looking for. We had one client, for example, that was in an all-for-one, one-for-all model. They pay about $300,000 a year in stop-loss premium and had over $1 million in reimbursements come from that captive in 1 year. When their renewal came, we were all sitting on the edge of our seat concerned about what that might mean for them, because in the traditional market, they would have seen a massive increase. This particular employer saw a very nominal increase in their premium in that year, and they saw the benefit of the captive right there and then. It made a lot of sense and banded together with other like-minded employers to protect themselves from those catastrophic years that they might have. So to wrap up captives, here are the things that employers really need to consider. First and foremost, how big is the captive? Do they take everybody with a pulse? Because if they do, you're likely not going to see the benefits that you would have from a well-managed plan. Second, what is the structure that they're using? Do they price the premiums lower than the market because that's how they return the surplus premiums, or do they give the employers a dividend at the end of the year? Finally, what's the model that this particular captive uses? Do they hold each employer on an island, and if they perform poorly, then they don't get the benefits of the captive, or do they have an all-for-one, one-for-all model? There's no right or wrong answer there, but we want to make sure that you're picking the solution that's best for you. And we do think that a captive is the right model to help smaller employers that otherwise couldn't afford stop-loss insurance to make that leap from fully insured to self-funding. It's important, however, for employers to understand that a captive in and of itself is not going to solve your healthcare challenges. It's only a tool that gives the ability to benefit if you've made smart decisions about every other aspect of your plan. For small employers that are considering the leap from a fully insured model to self-funding and being presented a captive as the way to do that, it could be a very viable option, but the captive in and of itself is not the solution, and we want to make sure employers understand that.